Welcome to today's video, where we break down why maximizing your health savings account before year-end can be one of the smartest financial moves you make. First, we'll hook into the urgency. Then, we'll cover the triple tax advantage, eligibility rules, the powerful last month rule, an action plan, and a controversial but potentially lucrative strategy. Never spend it now. Finally, we'll wrap with quizzes, key mistakes to avoid, and a brief disclaimer so you can move forward confidently. Here's the plan. First, we'll explain why HSAs are unique. Next, we'll cover eligibility and the last month rule that can unlock the full contribution. Then, we'll give you a step-by-step action plan. After that, we'll explore the investment-first approach. We'll compare HSA versus FSA, show current limits, run quick math examples, and test your knowledge with short quizzes. If you are thinking about switching from a high-deductible health plan to a traditional copay plan, be careful. Before you switch, you may have a limited window to contribute to an HSA. Missing the deadline could permanently forfeit tax-free growth potential. Let's transition into the core reason HSAs are so powerful. HSAs offer 3 layers of tax benefits. First, contributions are generally tax-deductible, reducing your taxable income. Second, any investment growth inside the HSA is tax-free. Third, withdrawals for qualified medical expenses are also tax-free. Additionally, after age 65, non-qualified withdrawals are taxed like traditional IRA distributions, without the additional penalty. Now that we've established the power, let's move to eligibility and the pivotal last month rule. Eligibility requires enrollment in an HSA-eligible high-deductible health plan with no disqualifying coverage such as Medicare or a general-purpose FSA, and you cannot be claimed as someone else's dependent. The last month rule allows those who are HSA-eligible on December 1st to contribute up to the full annual limit, even if they were not eligible earlier in the year. However, a testing period applies. You must remain HSA eligible through the entire following year. If you fail the testing period, the extra contributions attributable to the last month rule become taxable income and are generally subject to a 10% additional tax. With that foundation, let's move into a practical, step-by-step plan. Follow these steps. First, confirm that your current plan is an HSA-eligible HDHP. Next, verify that you will be eligible on December 1st to utilize the last month rule. Then calculate your applicable limit, including family coverage and catch-up if you are 55 or older. Afterward, contribute as soon as possible, ideally before your eligibility ends. Subsequently, invest the balance based on your risk tolerance rather than leaving it in cash. If affordable, pay current medical expenses out of pocket and keep your receipts. Finally, document your actions and set a reminder to review your plan before any coverage changes. This timeline highlights key checkpoints. From January through November, standard eligibility rules apply. On December 1st, the last month rule trigger occurs. If you are HSA eligible on that date, you may contribute up to the full annual limit for the year. December 31st marks year-end. But remember that the testing period spans the entire following calendar year. If you lose HSA eligibility during that testing period, the extra contribution attributable to the last month rule can become taxable with a penalty. The diagram also shows that contributions stop immediately once HDHP coverage ends and emphasizes investing early, saving receipts, and avoiding general-purpose FSAs next year unless you use a limited-purpose variant. On the left, the HSA is individually owned and portable, offering the triple tax advantage with the ability to invest and roll over unused funds indefinitely. It requires enrollment in an HSA-eligible HDHP. On the right, an FSA is generally employer-owned and often subject to use-it-or-lose-it rules. Most FSAs do not allow investing. A general-purpose FSA conflicts with HSA contributions, whereas a limited-purpose FSA, typically restricted to dental and vision, can be compatible with HSAs. These are commonly cited IRS HSA limits for 2024 and 2025 as of publication. Self-only and family limits increase slightly year over year, and the catch-up contribution for those age 55 or older remains $1,000. Always verify current IRS guidance and your employer's plan rules before contributing. Some experts suggest treating the HSA like a third retirement account. The idea is to contribute the maximum, invest according to your risk tolerance, and avoid spending from the HSA today. Instead, pay out of pocket for current medical expenses and save those receipts. Later, you can reimburse yourself tax-free, allowing your HSA to compound over decades. However, ensure you maintain an emergency cash buffer outside the HSA in case of unexpected expenses. Now let's test your understanding with a quick quiz. Quiz time. The question is, if you are HSA eligible on December 1st, how much can you contribute for that tax year? Options. A. Only a prorated amount. B. The full annual maximum under the last month rule subject to a testing period. C. Nothing if you plan to enroll in an FSA next year. D. Only if you had HDHP coverage for the entire year. You may pause the video now to think about the answer. We will discuss the answer in the next section. The correct answer is B. If you are HSA eligible on December 1st, you can generally contribute up to the full annual limit. However, you must remain HSA eligible throughout the entire following calendar year to satisfy the testing period. If you do not, the extra portion becomes taxable and may be subject to an additional penalty. Next question. Which statement about HSAs and FSAs is correct? A. You can contribute to an HSA even if you have a general purpose FSA. B. You must close your HSA if you enroll in an FSA. You may contribute to an HSA if your FSA is limited purpose or post-deductible. D. FSAs always allow investing like HSAs. You may pause the video now to consider your answer. We will reveal the answer in the next section. The correct answer is C. A general-purpose FSA conflicts with HSA eligibility. However, a limited-purpose or post-deductible FSA can be compatible with HSA contributions, subject to plan specifics. Let's quantify the opportunity. Suppose you contribute $2,000 right before the deadline and invest it with an assumed 7% annual return. Roughly speaking, after about 25 years, that single contribution could grow to over $10,800. Repeating this annually amplifies the effect of compounding in a tax-advantaged environment. Of course, investment returns are not guaranteed, so align your allocation with your risk tolerance. In summary, contributions reduce taxable income, growth is tax-free in the HSA, and qualified withdrawals remain tax-free later. Next, let's spotlight common mistakes to avoid. Avoid these pitfalls. Do not overlook your December 1st eligibility status, and do not forget the testing period implications. Consider investing rather than leaving funds idle if your objective is long-term growth. Avoid pairing a general-purpose FSA with HSA contributions. Save receipts for potential future reimbursements. Finally, if you plan to contribute, do so before leaving HDHP coverage. This pie chart illustrates a hypothetical breakdown of how people might allocate their HSA strategy over time. A portion for current medical spending, a larger share dedicated to long-term investing, a small slice for an emergency reserve, and another for future reimbursements using saved receipts. Your personal mix may differ based on risk tolerance, health needs, and cash flow flexibility. Please note that this content is educational and not tax, legal, investment, or financial advice. Consult a qualified professional for guidance specific to your circumstances. Tax rules and plan provisions can change, so verify current IRS publications and your employer's plan documents. To conclude, confirm your eligibility and consider using the last month rule where applicable. Maximize contributions while you are still eligible. Invest according to your tolerance to harness long-term, tax-free compounding. Avoid conflicts with general-purpose FSAs and keep thorough documentation, including receipts and awareness of the testing period. Finally, prepare for plan changes and review your approach annually. Thanks for watching. If you found this valuable, please like, share, and subscribe. Leave a comment with your questions or your HSA action plan so others can learn from your experience as well.